Risk tolerance refers to an investor's ability and willingness to endure market volatility and potential losses, while investment objectives are the financial goals an investor aims to achieve. Aligning the investment strategy with the investor's risk tolerance and objectives is crucial for creating a personalized and effective investment plan. Assessing risk tolerance involves considering factors such as age, investment horizon, financial situation, and psychological comfort with risk. Tools like risk tolerance questionnaires and financial simulations help gauge an investor's risk appetite and understand potential outcomes. Investment objectives can be categorized into growth, focus on capital appreciation, income, generate regular income, and preservation of capital, minimize risk, and protect the initial investment. The time horizon for achieving these objectives can be short-term, 1-3 years, medium-term, 3-10 years, or long-term, beyond 10 years. Aligning the investment strategy with risk tolerance and objectives involves choosing the right approach. A growth-oriented strategy is suitable for long-term growth objectives and higher risk tolerance. An income-oriented strategy focuses on generating regular income with moderate risk. A conservative strategy aims to preserve capital with low risk. A balanced strategy mixes growth and income, tailored to moderate risk tolerance and multiple objectives. Monitoring and adjusting the portfolio involve regular reviews to assess performance and alignment with objectives, rebalancing to maintain target proportions, and adapting the strategy based on changes in risk tolerance, objectives, or market conditions. This ensures the portfolio remains effective and aligned with the investor's goals. Understanding risk tolerance and investment objectives is essential for creating a personalized investment strategy. Use assessment tools like questionnaires and simulations to gauge risk tolerance and align strategies with growth, income, or preservation objectives. Regular portfolio monitoring and rebalancing help maintain alignment with goals, ensuring effective and adaptive portfolio management. Performance evaluation assesses how well a portfolio achieves its investment objectives. It is essential for making informed investment decisions and improving portfolio management. Various performance measurement metrics are used to evaluate different aspects of portfolio performance. Performance measurement metrics can be categorized into absolute metrics, which measure returns without considering risk, risk-adjusted metrics, which evaluate returns in relation to risk, relative metrics, which compare portfolio performance to benchmarks, and other metrics which include additional considerations like maximum drawdown and tracking error. Absolute performance metrics include total return, which measures the overall return of a portfolio including capital gains and income, and annualized return, which adjusts the total return to reflect a yearly rate. Let's calculate the total and annualized return for a portfolio. We define the initial and final portfolio values and dividends, then calculate the total return and annualized return. This example demonstrates the process of measuring absolute performance metrics. Risk-adjusted performance metrics include the Sharpe ratio, which measures risk-adjusted return using standard deviation, the Traynor ratio, which measures risk-adjusted return using beta, and the Sortino ratio, which is similar to the Sharpe ratio but focuses on downside risk. Let's calculate the Sharpe, Traynor, and Sortino ratios for a portfolio. We define the portfolio returns, risk-free rate, and risk measures, then calculate the Sharpe ratio, Traynor ratio, and Sortino ratio. This example demonstrates the process of measuring risk-adjusted performance metrics. Relative performance metrics include alpha, which measures excess return relative to a benchmark, beta, which measures the sensitivity of the portfolio to market movements, and the information ratio, which measures excess return relative to a benchmark adjusted for tracking error. Let's calculate alpha, beta, and the information ratio for a portfolio. We define the portfolio and market returns and the risk-free rate, then calculate beta, alpha, and the information ratio. This example demonstrates the process of measuring relative performance metrics. Other performance metrics include maximum drawdown, which measures the largest peak-to-trough decline, and tracking error, which measures the standard deviation of the difference between portfolio and benchmark returns. These metrics provide additional insights into portfolio performance and risk. Let's calculate maximum drawdown and tracking error for a portfolio. We define portfolio values over time, calculate maximum drawdown, and calculate tracking error. This example demonstrates the process of measuring these additional performance metrics. Performance measurement metrics include absolute metrics like total return and annualized return, risk-adjusted metrics like the Sharpe ratio, Traynor ratio, and Sortino ratio, relative metrics like alpha, beta, and the information ratio, and other metrics like maximum drawdown and tracking error. These metrics provide a comprehensive evaluation of portfolio performance, helping investors make informed decisions.